To make money in the stock market, you need to buy a strong company at an attractive price. Without buying a strong company at an attractive price, your investment is not going to look so attractive at all. And in this video, we're going to be taking a look at whether BMY Stock is a strong company at an attractive price. And if you don't know, BYM is one of the largest pharmaceutical companies in the whole world. They make treatments to help make people feel better with issues like cancer, HIV, and diabetes. And one of the largest concerns I have with the stock is their debt. They currently have $43 billion in long-term debt. And that's nothing to glance over. That's up from $24 billion from 2019. So they essentially took on an additional $20 billion in long-term debt over the past year alone. And for a stock that currently has a market capitalization of $140 billion, that's a lot of debt. Almost 30% of the entire company's market value is just debt. And if you're trying to find a strong company to invest in, you definitely don't want it to have a lot of debt. There are just too many examples of companies struggling due to their long-term debt. I remember that maybe about a year ago, Kraft Heinz was taking on a lot of debt, and Wall Street started to notice a problem with that as analysts were giving them ratings of junk bond status. Essentially, investors did not think that they would be able to pay back their debts. Then do you want to know what happened? The stock was almost at $100 per share. And then over the past few years, it came down all the way down to $20 per share. You just can't take your mind off of a company's debt. Not for 1 second at all. If you do, you snooze, you lose. And when we take a look at Bristol Myers Squibb stock's debt, or BMY's debt, they have $43 billion in debt, but that might not actually be a problem, and here's why. What I have on screen right now is a snapshot from their 2019 annual report, and it tells us how much debt is actually due each year. And we can see that they have to pay about $2 to $5 billion back each year. This makes their debt seem a lot more manageable than just a big pile of $43 billion. It's like someone who makes $40,000 per year taking out a mortgage for $100,000. The mortgage is a big pile of debt. It's daunting. It's better if it did not exist, but it's manageable over the long term, and it won't cause anyone, hopefully, to go bankrupt. And it's like the same thing with BMY right now. They just have a lot of debt that they have to slowly pay off over the long term. But it's unlikely to cause any major issues like a bankruptcy or anything like that. But that can actually slow their growth still. You have to keep in mind that they are paying about $2 to $5 billion per year, which is actually a lot of money when you compare it to their free cash flow, how much money they're making per year. Historically, they've been making about $4 to $11 billion per year. And on a good year, if they make $11 billion but then have to pay back $4 billion of debt, about 30% of their profits or free cash flow are just going to debt. And you can't ignore the fact that they're losing a whole bunch of their free cash flow. It's not going back into the company because they have so much debt. Because they will have less cash to grow the dividend, less cash to pay their current dividend, less cash to reinvest in the company to actually grow their earnings so that they can pay a better dividend in the future. But for BMY specifically, the fact that they're paying out a huge portion of their free cash flow or profits back to their creditors might not actually be such a bad thing. The reason is because they have so much in cash and cash equivalents. As of right now, they have $21 billion in cash and cash equivalents. So they have a huge amount of cash just sitting on the sidelines waiting to pay back their creditors or waiting to be paid out in dividends or to grow the company. Although this company does have a lot of debt, they have so much cash on the sidelines, so they're still going to be able to grow the company, pay their dividends, and pay back their creditors, so their debt should not constrain them. And now that we know that their debt is not dangerous, let's take a look at their valuation right now. Typically, this stock trades at a PE ratio between 13, 14, and 18, around that range. And right now, their PE ratio is astronomically high. It's at a PE ratio of 93. To put that in perspective, it's trading like an Amazon right now, theoretically. Amazon has a PE ratio around that also. And the reason their PE ratio is so high right now is because they've been taking losses for the past couple of quarters. And when a company's earnings go down, their PE ratio is naturally going to go up. all things considered equal, of course. And it's important that I mention this right now. When you are investing, the past does not matter that much. If a company has been unprofitable, it does not mean that a company will not be profitable in the future. If a company has been growing their earnings dramatically in the past, it does not mean that it will be sustained in the future. And an investor only gets rewarded for what happens in the future. If a company all of a sudden makes a whole bunch of money next year, the investor is definitely going to get rewarded, even if the company has been unprofitable for the past 5 years, 10 years, or 10 decades. So you have to focus on how a company will perform in the future, because that's all what matters in the stock market. And BMY definitely has a strong future. For 2020, this year, they're expected to make about $6.24 in EPS. That puts them at a forward PE ratio at about 10. And I think that speaks for itself. That's just a very low PE ratio for this company. And it's a very low forward PE ratio in general for any company that's experiencing their type of growth. Next year, they're expected to grow sales by 8%. And that's a huge growth for a company that's trading at a PE ratio or forward PE ratio of 10. Typically, companies that are trading at a forward PE ratio at around 10 have 0% growth, but this company is expected to have 8% growth in 2021. So their valuation is actually pretty good with this stock. But speaking of growth, something looks very bad with the stock, and it's actually their dividend growth. Over the past 5 years, they've been growing their dividend by about 2% per year, and pretty much all investors would say that's a very bad dividend growth, especially for a company that has a 3% dividend yield. There are many other companies out there which have much higher dividend growth rates and much higher dividend yields. And sometimes it's actually a good thing that a company is not actually growing their dividend. It can actually be a very wonderful thing. Right now, this company, BMY, has a return on invested capital of 11% based off of what they're expected to make this year. Would you rather have your company pay a 3% dividend yield, or would you rather let them keep the money, grow the money by 11%, and then pay a much better dividend next year? Unless you're one of those people who really needs dividends to live off of and needs a passive income to pay bills and expenses, I think this company has a very solid dividend. A 3% dividend yield isn't very bad at all. It's actually very good for a company that still has good growth. And you're getting a 30% payout ratio with this company. So they have tons of room to grow their dividend, and they have a fairly high yield at 3%. So I think this company's dividend is actually very good. They're a pretty safe company in terms of their debt and balance sheet, and they're at a good valuation. So I think this is definitely a pretty decent stock. But let me know down in the comments what you think about the stock. I would actually love to hear from you.